Well, hello and welcome to the Lending Podcast. We are your hosts. I am Jeff Jones and this is JB. We're coming to you from Austin, Texas, and it is a new year coming in hot, 2025. So what are we talking about today, JB?
Well, Happy New Year, first of all.
Happy New Year.
Yes, 2025 is going to bring us an exciting time in real estate. We have seen a lot of activity pick up over the last month or so. And I think a lot of aspirational buyers who have had this on the shelf for a year or two have decided, okay, now's the time.
This is your year.
This is your year. You know, and what better New Year's resolution than to buy a house? So,
I mean, there are so many great news reports on pent-up demand. People like talking about all these people that currently own a home, have a great mortgage rate, don't want to trade that in. And they've been waiting for 2 years.
Yeah.
You know, and so 2025 might be your year to no longer wait, but actually, you know, get that bigger home you might want. And just in time for that, you know, we have what we call new loan limits.
Yep.
So loan limits go up pretty much each year.
Right.
You know, and what does that mean?
Well, there was a period of time there where we didn't have a lot of appreciation in the real estate market, kind of back in 2010, 11, 12, 13. It was just pretty, back in the, I would say back in the good old days, but those weren't really the good old days. These are kind of the good old days right now because our appreciation is pretty rapid, you know, nationwide. Now, right here in Central Texas, we've certainly had a little bit of a spike in 2022. We've had some pullback, but I'm telling you, property values are holding. We're seeing multiple offers on contracts. Yes, there's some value out there in the marketplace. Of course, there's always going to be a distressed seller, or there's always going to be a situation where a seller's willing to kind of dump their property. That's not the norm right now. No. We're seeing very, very low foreclosures. We're seeing very, very low, distressed sales. And so the buyer opportunity is out there for sure. And for a lot of our clients, it is a move-up situation. It's a move-up conversation about, hey, I've got a house to sell. My family's growing. My situation's changed. I need a bigger house, or I need to move to a different school district, whatever. And so the loan limits specifically help borrowers obtain the best financing they can for a specific sales price range. And so, give you an example. Right now, up until January 1st of 2025, our loan limit for the last year has been $766,550. This is for conventional conforming loans. What does that mean? That's the loan limit, and this is anywhere in Texas. Obviously, we're in Texas. The loan limits are different throughout the United States, California, and maybe some of these high-cost areas, but higher cost areas. But Central Texas and all of Texas has been $766,550. Now, that is the loan limit that Fannie Mae and Freddie Mac, who buy the majority of the mortgages out there, that's the loan limit that they'll guarantee up to that amount that they will buy on a conventional loan. Okay, over that, $767,000 mortgage in Texas anyway is considered a jumbo. Okay, before January 1st, and really the loan limits came out in December, which is nice. So we can now close $806,500 on a conventional loan. So it's about a $40,000 increase from 2024 to 2025. And here's what that tells me. Ultimately, that tells me prices are still increasing. Loans, or the activity is very robust still in this marketplace, even though, yes, there's more inventory. But why would Fannie Mae and Freddie Mac increase the loan limits if our market is not appreciating?
Right, they would,
and it is. So that's good. So $40,000. I mean, that's almost 5%, or maybe it's more than 5%, but about 5% increase, right? $40K on a 766 prior loan.
And why that's important is because a conventional loan, if you're a first-time home buyer, only requires 3% down.
That's right.
If you're not a first-time home buyer, you still only have to put 5% down.
Yep.
You know, and so when you get above those loan limit prices and you go into the jumbo category, that's our buzzword for anything bigger than $806,500 now. That jumbo category, a lot of those programs are 10, 20% down.
That's right.
You know, so you're needing a much larger chunk of money on a bigger amount. So it puts you out of that 5% down option a lot of times when you go to jumbo. Now, pricing of how the rates work, there's a give and take in those. because the jumbo market is very different than a conventional market. We have all kinds of different banks and guidelines that are investing into those than what is doing Fannie and Freddie Mac coupons. So, so the secondary market is different. How those are bundled together and then resold is different, which affects the buyer. And so, good. So, so we got bigger limits, which allows us to have more flexibility for less money down on a big home.
That's right. That's right. And what it does too is it establishes the loan limit is obviously different than the sales price, right? So if your sales price is $850,000, you can do a loan limit of $806,500. You could put just that delta down, that $44,000 down, right, 5% down, and keep more of your cash, right? So the minimum down is 3% for first-time buyers. The minimum down, if you're not a first-time buyer, would be 5%. In most cases, there are some exceptions, rare exceptions, but that's essentially where we are on those limits. Now, if you have something at $900,000, $950,000, or $1 million, you could still finance the $806,500. However, we look at that loan to value as being 5% down, 10% down, 15%. What's the best way to structure the loan? So you mentioned jumbo. We look at the jumbo loan options. We look at the conventional loan options. And then our clients decide, right? We share those results with you, those options with you. And in many cases, the conventional loans are better. They're priced better. The rates are a little better. The closing costs are perhaps a little lower.
Yeah.
And so that's the benefit.
And I'm going to throw a curveball on you.
Yeah.
So when you get into these price buckets, when you're talking like, we used to be talking in the 700,000s for conventional. Now we're getting into the 800,000s in conventional, right? You mentioned a $900,000 price point. What a lot of people don't realize is there even is creative, good options of what we call piggyback loans.
Yes.
So some people call them 80-10-10s with a 10% second loan. Some people do, the 15% in 5, so they split it up a little bit. So tell people about what those look like.
Yeah, just closed one yesterday.
Nice.
So
Because they are popular, but a lot of lenders
popular.
aren't comfortable with them.
Yeah, and not every bank offers them. Not every lender offers them. So this particular scenario was 1.11 million, so $1,110,000 was the sales price. They wanted to put 10% down. They had additional cash. They wanted to hang on to some of that. They have some different projects they're working on and needs for cash. And so that's one of the most important questions we can ask, of course, is yes, how much cash do you have budgeted for the down payment? But specifically, how much cash do you want to have left over after closing?
After you get the keys.
That's right. And so this particular client, we talked through their options, and I said, yeah, we can do a 10% down, $1.1 million purchase. Well, it was $111,000 down. So if you do the math, it was $999,000 was how much they wanted to borrow,
Funny.
right?
Yeah.
So just out $1 million. Here's the key. If we had done a 10% down jumbo, right? So a $999,000 loan, the interest rate was going to be way higher. The closing costs were going to be way higher, and they were going to have mortgage insurance, PMI, on a jumbo, okay? Skyrocketed their payment, just wasn't appealing to them. So your question about the piggybacks, we did a first mortgage and a second mortgage. That second mortgage is considered a piggyback. It's also called a purchase money second. So it happens simultaneous with the closing of the home, right? And so we reverse engineered. We did a $766,000 first because that's what the limit was when we locked it. And then we did a second mortgage that was the difference between $999 and $766. I think it was $230,000 roughly, $234,000. And so when we closed on that loan, we had kind of like a 70% first and a 20% second and a 10% down, right? So you could use these second mortgage, these purchase money second mortgages to bridge the gap between putting 10% and all the way to 20% down. So they bought $1.1 million house and they did not put 20% down. They put 10% down.
They put 10% down. They had a conventional loan.
Yes.
And what's beautiful is, you're closing both loans at the same time. So the lender can be really dialed in for this so that both loans start on the same day. It all happens at the same time. And you have a rate that's not just your primary conventional 80% rate or your max limit rate, but you have now what we would call a blended rate. right?
Right.
So explain to people what that blended rate does.
Yeah, the blended rate is really the weighted average. So you have X amount of loan at the first mortgage rate, and you have a Y amount of loan at the second mortgage rate.
Right.
And so, ironically, in this case, the rates weren't that different. They were
Funny.
maybe a half a point difference. So the weighted
That's a
average
great second loan then.
yeah, it was a pretty good second. All things considered. So, but we take the percentage of the amount you borrow times the interest rate on the first, and then the percentage of the loan that you borrowed on the second, and use a weighted average calculation to come out with the true cost of your money. And in most cases, that's going to be cheaper than in that case than having mortgage insurance, which is insurance that the borrower pays to protect the bank.
Right.
The mortgage insurance does not really protect the borrower; it protects the bank. And at certain income levels, you cannot write off mortgage insurance (PMI) as a tax deduction.
Right.
And that's usually if you make more than $100,000 a year. And if you're buying $1 million in one house, you're making more than $100,000 a year. So they couldn't have written that off as a tax deduction. And so we did the weighted average calculations. It made sense, And here's the other thing: they have a piece of property to sell. They have a lot that they need to sell, and when that sells, they'll have roughly the amount of proceeds to pay off or pay down on that second significantly. And then we can look at refinancing in the next year or two. We'll see what rates do, right? But for their situation, it was, how can I buy $1 million home and put 10% down? And we got it done, right? There's a lot of ways to do it.
Yeah, and it's quite a different game than it used to be. We bought our first home in 2003. 2002, 2003. And we had one of those terrible loans. It was an 80-10-10.
Oh, yeah.
But that 10% second was at 22.5%.
Oh, wow. I didn't know that was a thing. That's usury.
It really was.
Oh, my.
So
wait, was it on a credit card?
It pretty much was terrible.
Oh, man.
I was a first-time home buyer.
Yeah,
I was 22 years old.
Sure.
23. And by the time we sold the house 3 years after we bought it, made a bunch of money.
I was going to say, what did the sale look like? You
Okay, so let's do some numbers. This was back in California.
Yeah.
So in Redding, California, shout out Redding. Bought the house for $159. 3 years later, sold it for $249. Made $90K. That's how I paid off our student loans, because we had $87,000 of student loans in debt.
That's awesome.
So I didn't really keep any money. I just decided to spend it all. I didn't have a financial advisor at the time that advised me different.
Do you remember what the first mortgage rate was?
It was 8.25.
Okay. So 8.25 and 22. So the blended average, quick math, probably 10 or 11, something like that.
Well, what's funny is when the balance never changed on that 22.5.
Oh, it was just
in
like
3 years.
Yeah, sure, like an interest only.
It was basically an interest only payment that was being made.
Well, because the amortization, it's so interest heavy, you're paying like $5 in principal.
Yeah, and I forgot what that loan was called. The first one, it had the option loan, so I had 4 payment options every month.
Right.
Remember that thing? I don't think those are allowed. And one of them was a negative amortization option, where I can actually pay less than interest. I could pay $45 a month.
Yeah.
I don't know what the point of that was, but it would actually increase the balance.
The point of that was to help people buy homes, but also put them in a really bad spot.
Yeah,
so,
those are not allowed right now.
We don't do a lot of negative amortizing.
All that to say is we've come a long way. These second loans. So just circle back. So people that are out there, if you're listening to this podcast and you're shopping and you don't know what price point changes your programs, because that does matter, talk to your lender, because now all 700s can be covered with a conventional loan, $700,000 purchases of any range, because now we can go to 806 500.
That's right.
In 2025. And 800s, we can still play around with conventional loans. So whether that we max it out to 806 500 and then you pay the rest as your down payment, or we can stretch it like you did to 1.1 million, where we got you into a conventional, but we also got a piggyback loan.
Yeah.
So as we're in those 800 ranges, we can get really creative. As you go to 900 and $1 million, we could still get really creative to see if we can keep you conventional.
Right.
Before you go jumbo. So if you're out there shopping and you're looking at a home that's over 800,000 and you're getting quotes for jumbo loans, just make sure that you talk to a lender that looks at the other options for conventional pricing for you. Because right now, in this day and age, conventional is beating jumbo rates pretty well. So we've talked about jumbo, we've talked about conventional.
Yep.
Let's talk a little bit about government loans and
Yeah.
FHA specifically, because there's been changes there too.
Yeah, FHA. So the new floor, I guess, ceiling,
the lowest amount
the lowest amount of the limit
of the max
for FHA, I don't know how to say that exactly, is $524,225. So $524,225.
is the loan amount value.
Yeah, so anywhere in the country,
Nationwide. Right.
nationwide, that would be an FHA allowable loan amount. Now, in Central Texas, our loan amounts are actually a little higher than that.
Quite a bit higher.
We're looking up they haven't posted. It was 571, 550. Again, these go into effect January 1st, 2025. So right about the time that folks are starting their new year and their work week after the New Year's, we got these new loan limits. And so if you reverse engineer that, that's about a $600,000 purchase price for Central Texas, right? Because our county limits are a little higher than that floor. And essentially you could buy a $600,000 house and put 3.5% down.
Okay.
And or use down payment assistance programs, or use, obviously we talked about gift funds, but that $600,000 price point, that's a really healthy price point for a buyer to put 3.5% down, which is, what is that, just over $20,000.
That's right. And what's interesting with FHA is there's a lag of them releasing their county-wide limits.
Right.
Because there's a lot more work to be done on that analysis, because every county they have to look at if it's economically higher cost of living than the rest of that national floor number. And so like our current, I should say, numbers as of today for all of 2024 are still there. So that was the 571, 550 for Travis County and Williamson County if you're here in the Austin area. And so when you're shopping and you're not sure what county you're going to be in, and you're talking to your lender that is possibly looking at an FHA loan because they are wonderful loans, just know that the county changes the limits. So so when you get a pre-approval, sometimes on our pre-approval letters, we know which county they're shopping in, and sometimes they're like, I'm going to look in Hayes County, I'm going to look in Travis County, I'm going to look in all these, Guadalupe County. Your pre-approval letter will change based on your county because we're going to put you in that FHA program.
That's a really good point, because if let's say you're approved for $600,000, but you find a property that's in a county where the limit's 524, then you would have to put that differential down in down payment. That's like $75,000 in down payment.
And usually people don't go FHA because they have that.
That's right. Yeah. So, and there's reasons obviously that you'd go FHA if you did have a larger down payment. There's some actually benefits to it. But most of our FHA buyers are going to be 3.5% to 5% down. There's some thresholds. If you get to 10% down, there's some benefit, 15, 20. But the thing about FHA that really I think is encouraging for this, certainly for the coming year, is the pricing. Interest rates have actually been better on FHA in many cases than conventional, and the mortgage insurance is cheaper in many cases than conventional.
Let's talk about that a little bit,
Yeah.
because historically that's not usually the case.
Right.
And so what we've seen over the last year and a half, I would say, we've had 2 years with pretty elevated rates compared to what we were at years ago.
Yeah.
We're still pretty much in par with like a 10-year history, but a 5-year history, we're up. So all that to say is conventional pricing for the last 10 years historically has been better rates than an FHA rate, because an FHA usually are qualifiers for people that have less income calculations, so they're at a tighter debt to income ratio, getting to like the 50%, or they have a credit challenge, which is a higher risk level, or they need more down payment assistance, so that you have a repayment challenge. So FHA traditionally, for a 10-year period, was higher rates because of higher risk. But in the last year and a half, FHA has been beating conventional because the numbers have changed. Historically, FHA foreclosures are actually not as bad as they used to be. So the foreclosure rate has gone down below 1% nationally. That's very low. And so the old adage that people used to foreclose on their home regularly hasn't been going on in the last 5 years, really. So all I have to say is the risk factors have changed and FHA pricing has gotten more competitive than conventional. So sometimes, we compare apples to apples with a monthly budget. So we're doing a pre-approval phone call, and we're like, conventional loan, this is what your monthly payment's going to be. FHA, this is what your monthly payment's going to be. And right now, FHA's monthly payments, when you factor in their mortgage insurance and their rate, and then their, all the costs that go involved, is still beating conventional more than 50% of the time.
It beats it often, and really it's because of that mortgage insurance factor. The thing with FHA is PMI, mortgage insurance, which of course protects the lender, is a standardized amount. So whether your credit score is an 800 or a 600, it's the same. Whereas in the conventional space, it's risk-based pricing, which means the higher credit score you have and the lower debt to income ratio, the lower risk. The lower risk means lower costs. And so there's a teetering point, right, where we do these analysis and we send them out and say, gosh, you're on the teetering point where FHA really is more competitive for you. But it's not us placing you in a loan. It's you choosing. We're going to give you those options, and we'll look at the pros and cons. There's some cons with an FHA loan. If you can go conventional and the payments comparable to an FHA, their closing costs are cheaper in many cases because you don't have the upfront mortgage insurance premiums. So there's some ways to look at this through a different lens. But I'm with you. You had a client recently. I think maybe it was 4 or 5 months ago, but the FHA payment was $300 a month less.
Yes, $300 a month less.
And we closed one where I remember specifically it was
crazy.
$500 a month left. $500 a month less to go FHA versus conventional. Again, all kinds of different variables. And
that's a lot of money on a weekly budget.
Yeah.
It's over $100 a week.
That is a lot. Yeah.
You can have fun with that.
So it's a lot of Chipotle.
It's a lot of Chipotle. Well, I'm excited. I mean, hopefully people are getting out there. We're pretty darn hopeful for a very good 2025 in our industry. We've had a lot of people leave our industry, realtors, lenders, title companies, insurance people, because the number of buyers has been really low. We're hopeful to see a renewal of interest for people to buy. And so if you're out there and you're listening to this and you're like, I don't exactly know all of what they're saying, but I'm excited. Our goal is to make dreams come true, to help people get to wealth building with their homes, and to really be a resource for people. So if you're out there and you have questions, we're here for you. Any other final thoughts?
2025 is going to be a great year. These new loan limits, I think, will definitely bridge the gap with most of our move-up buyers, right? The sell buys and maybe some first-time buyers that are in that $1 million price point. We see that for sure. And to be able to borrow $800,000 on a conventional loan and it not be a jumbo, we didn't even talk about the underwriting requirements, but traditionally conventional underwriting requirements are a little more lenient than some of the jumbo underwriting requirements. And the debt to income ratios are a little more liberal than they are on the jumbos, especially for our self-employed borrowers. So it's just to be able to navigate that matrix and get to an $800K loan on a conventional loan, I think is super exciting. So we're looking forward to 2025, and we're here for you. If you have any questions, comments, suggestions, and what you want to hear, let us know what you want to hear about. And we look forward to seeing you soon.
Thank you so much. Have a great day.
Take care.